The year is 2026, and somewhere inside the most expensive office buildings ever constructed, the smartest people in the world are spending $5 trillion on a bet. Not on oil, not on land, not on gold. On a prediction that artificial intelligence will be worth the most spectacular infrastructure gamble in the history of capitalism. But let's get one thing straight before the champagne goes flat. This isn't a story about robots taking your job. This isn't a TED Talk about the future. This is a forensic audit of the biggest financial experiment since the dot-com era. And right now, the math doesn't add up. Imagine this. You build the most expensive factory in human history. You fill it with machines that cost more than fighter jets. You hire the most brilliant engineers on the planet. And then you turn it on. And 95% of your customers say, "We got nothing. Not a little something. Not a slow start. Nothing. Zero return." That is not a startup hiccup. That is a 5-alarm fire in a building made of money. How do you justify $4.5 trillion in market value for a single chip company? How do you explain a startup valued at $500 billion that loses $14 billion a year? How do you build a $1 trillion infrastructure plan with only $52 billion in actual committed cash? How do you spend $400 billion a year on factories when the product they make returns zero profit for 95% of the customers who buy it? Those aren't rhetorical questions. Those are the charges. And today, we're going through them line by line. Today, we're not debating whether AI is real. It is. We're not debating whether it is useful. It can be. We are auditing the bill. This is the forensic breakdown of the most concentrated financial bet in market history. This is the AI bubble. $5 trillion in tech. And the question no one wants to answer. What happens when the music stops? To understand how we got here, you have to understand one company, one chip, one man in a leather jacket. In November 2022, a nonprofit called OpenAI released a chatbot called ChatGPT. Within 2 months, it had 100 million users, the fastest adoption of any technology in human history, faster than the iPhone, faster than electricity. And every single one of those AI models, every chatbot, every image generator, every coding assistant, they all needed one thing: graphics processing units, GPUs, and one company made the best ones, NVIDIA. This is the first nail in the coffin. The shovel seller's paradise. In January 2023, NVIDIA was worth about $345 billion, a big company, respectable. By October 2025, it touched $5 trillion. Let me spell that out for you. 5 followed by 12 zeros. That is a 1,350% increase in less than 3 years. It made NVIDIA the most valuable company on Earth. More valuable than the entire GDP of Japan. Jensen Huang, NVIDIA's CEO, became the face of the AI gold rush. And here is the thing. NVIDIA isn't building the AI. They're selling the shovels. Every tech giant, Microsoft, Google, Meta, Amazon, OpenAI, they were all lining up to buy NVIDIA's chips like desperate gamblers buying lottery tickets. And NVIDIA was cashing every check. Revenue went from $27 billion in fiscal 2022 to over $130 billion in fiscal 2025. That is not growth. That is a vertical line. NVIDIA's price-to-earnings ratio sits around 45. High but not insane, you might say. But here's the catch. That ratio is based on current earnings that are almost entirely driven by other companies spending money they haven't earned yet. NVIDIA's revenue is Meta's expense. NVIDIA's profit is Microsoft's capital expenditure. NVIDIA's growth is OpenAI's cash burn. When your revenue depends on your customers spending money they don't have on products they can't yet monetize, your earnings aren't a floor. They're a ceiling that someone else is holding up. The top 5 hyperscalers, Microsoft, Meta, Alphabet, Amazon, and OpenAI, are expected to spend $440 billion on capital expenditure in the next year alone. That is up 34% from last year. These companies have collectively committed to spending more on AI infrastructure in the next 5 years than the United States spent on the entire interstate highway system, adjusted for inflation. But here is the dirty little secret of every gold rush in history. The shovel sellers always get rich. The question is whether the miners find any gold, because if they don't, they stop buying shovels. And that is when the shovel seller's stock price stops looking like a rocket and starts looking like a cliff. This brings us to the second nail, the circular money machine. If you want to understand why this bubble is different from anything we've seen before, you need to follow the money. And when you follow the money in AI, you end up going in circles. Literally, let me walk you through the most elegant Ponzi-adjacent structure in corporate history. OpenAI takes investment money from Microsoft. OpenAI uses that money to buy chips from NVIDIA. NVIDIA then invests $100 billion back into OpenAI. OpenAI uses some of that money to rent computing capacity from CoreWeave. CoreWeave, which NVIDIA also owns a stake in, uses that rental income to buy more NVIDIA chips. And Microsoft, who invested in OpenAI, counts OpenAI's spending on Microsoft's Azure cloud as revenue. Read that again, I'll wait. Because what you just heard is not a business model, it is a financial centrifuge. Money goes in one end, gets spun around between 5 companies, and every time it changes hands, someone books it as revenue or growth. An MIT economist named Daron Acemoglu looked at this structure and said, "The danger is that these kinds of deals eventually reveal a house of cards, and the accounting tricks go deeper." Gil Luria, an analyst at Davidson who has been tracking big tech's data center boom, discovered that some companies are using what are called special purpose vehicles to keep debt off their balance sheets. Here is how it works. The tech company invests in a data center. Outside investors put up most of the cash. The special purpose vehicle borrows money to buy the chips inside the data center. The tech company gets the computing power, but the debt doesn't show up on their books. It is financial engineering designed to make the leverage invisible. If that sounds familiar, it should. It is exactly the kind of off-balance sheet maneuvering that preceded the 2008 financial crisis. Meta, Alphabet, and Oracle alone will need to raise $86 billion combined in 2026 just to keep building. After Oracle sold $18 billion in bonds in September 2025, its stock dropped 5.6% the next day and hasn't stopped falling. And it gets worse. OpenAI committed $300 billion to Oracle for computing power over 5 years. That is $60 billion a year. OpenAI's total revenue in 2025 was $13 billion. They committed to paying Oracle nearly 5 times their annual revenue per year. For 5 years when that deal was announced, Oracle's stock soared 40% in a single day, adding $1/3 trillion in market value. Since then, Oracle's stock has dropped 37%. The market figured out the math. This is nail number 3, the 95% void. In July 2025, researchers at MIT's Media Lab published a study that should have been a 5-alarm fire on Wall Street. The title was The Gen-I Divide. The finding was devastating. Despite $30 to $40 billion in enterprise investment in generative AI, 95% of organizations reported zero measurable return, not disappointing returns, not slow returns. Zero, no impact on profits, no impact on the bottom line, nothing. The researchers studied 300 public AI implementations. They interviewed 52 executives. They surveyed 153 senior leaders, and the conclusion was brutal. Over 80% of companies had explored AI tools. Nearly 40% claimed deployment, but only 5% of custom enterprise AI solutions ever reached production. 5%. Let me put that in perspective. Imagine you are a CEO. You just spent $10 million on an AI transformation project because every consulting firm on earth told you it was the future. Your board approved it. Your shareholders cheered it. You hired a chief AI officer. You built a team. And then your finance department runs the numbers and says, it did nothing. Now multiply that by every Fortune 500 company in America. That is $40 billion of corporate money lit on fire. One CIO in the MIT study put it perfectly. We've seen dozens of demos this year. Maybe 1 or 2 are genuinely useful. The rest are wrappers or science projects. That is the voice of someone who just discovered that the emperor has no clothes, and he is not alone. He is 95% of the room. And here is the detail that makes the MIT finding even more damning. The 5% of companies that did see results, they shared a very specific pattern. They focused on one single pain point, not an AI transformation, not a revolution. One problem: back office automation, document review, customer support, the mundane, boring, unsexy work. The companies that tried to use AI to revolutionize everything, the ones that built internal AI teams and custom models, they failed at nearly twice the rate of companies that just bought off-the-shelf tools. In other words, the companies that spent the most got the least. The AI gold rush rewarded the pragmatists and punished the believers. But the venture capital machine didn't get the memo in early 2025. 58% of all global venture capital went to AI startups. There are now 498 AI unicorns, companies valued at $1 billion or more. Over 1,300 AI startups have valuations above $100 million. The former CEO of Intel said it is insane that startups with 3 people and an idea are receiving funding at such high valuations. That is not rational behavior, he said. Someone's going to get burned. And Demis Hassabis, CEO of Google DeepMind, said, "You look at seed rounds with just nothing being tens of billions of dollars. That seems a little unsustainable." Silicon Valley, in the words of Ilya Sutskever, former chief scientist of OpenAI, has more companies than ideas. But if the returns are bad, wait until you hear about the moment the entire narrative almost collapsed in a single afternoon. Because on January 27, 2025, a startup from Hangzhou, China, did something that should have been impossible. This is nail number 4, the DeepSeek earthquake. DeepSeek, a 1-year-old Chinese AI company, released an AI model called R1 that matched the performance of the best American models. It could reason, it could code, it could answer complex questions, and it cost $5.6 million to train. $5.6 million. OpenAI spent over $100 million training GPT-4. Some estimates put the total development cost of America's top models at billions. The market's reaction was instantaneous. On January 27, 2025, NVIDIA lost $589 billion in market value. In one day, that is the single largest one-day loss for any company in the history of Wall Street. The Nasdaq shed $1 trillion. Broadcom dropped 17%. Marvell Technology fell 19%. The Philadelphia Semiconductor Index had its worst day since March 2020. Think about what DeepSeek actually proved. The entire AI investment thesis was built on the assumption that you need the most expensive chips, the most massive data centers, the most astronomical budgets to compete. DeepSeek built a competitive model using older, cheaper NVIDIA chips that the US had already banned from export to China. They used 2,000 specialized chips where American companies used 16,000. They spent millions where others spent billions. If a garage band from Hangzhou can match your $100 billion symphony orchestra, what exactly are you paying for? That one question, should have ended the party. Instead, the stock recovered within weeks. The market chose to ignore the warning shot. Mark Anderson called it II's Sputnik moment. Jensen Huang called it excellent. And the spending continued because, in a gold rush, nobody wants to be the first one to stop digging. But DeepSeek didn't just threaten NVIDIA. It threatened the entire investment thesis. If models can be trained cheaply, you don't need million GPU clusters. If you don't need million GPU clusters, you don't need to spend $80 billion a year on data centers. If you don't need to spend $80 billion on data centers, you don't need to borrow against future revenue. And if the spending stops, NVIDIA's revenue collapses, CoreWeave's debt goes bad, and the whole circular financing machine grinds to a halt. The market processed all of this in about 6 hours and then collectively decided to pretend it didn't happen. Because the alternative, acknowledging that the entire infrastructure build-out might be wildly oversized, was too expensive to admit. And here is the final knife twist from DeepSeek. The model is open source free. Anyone can use it, modify it, deploy it. OpenAI charges $20 to $200 a month for its subscription. DeepSeek's R1 is 20 to 50 times cheaper to run than OpenAI's comparable model, when the budget option performs as well as the luxury option. The luxury option doesn't have a business model anymore. It has a branding problem. And that brings us to the company at the center of the storm, The company that started the gold rush absorbed more capital than the Manhattan Project and still can't turn a profit. This is nail number 5, the OpenAI black hole. OpenAI is valued at $500 billion. Let that sink in. Oracle, a company with $14.9 billion in quarterly revenue and nearly $11 billion in cash on its balance sheet, is worth $572 billion. OpenAI, which made $13 billion in all of 2025 and lost $9 billion doing it, is valued at nearly the same. The company spends $1.69 for every dollar it earns. OpenAI's own internal projections leaked to the Wall Street Journal show the company expects to lose $14 billion in 2026, $14 billion in 1 year. And it gets worse. Cumulative losses through 2029 are projected at $115 billion. They don't expect to be cash flow positive until 2029 or 2030. That is 4 more years of burning money at a rate that would bankrupt most nations. And yet, they keep signing bigger checks. OpenAI has committed $1.4 trillion in spending over the next 8 years. $1.4 trillion, that includes $300 billion to Oracle, $250 billion to Microsoft, $150 billion to AMD for chips, and $500 billion for the Stargate data center project announced at the White House with President Trump and SoftBank's CEO standing right next to Sam Altman. But here is the forensic detail that should make your blood run cold. The Stargate project has a headline commitment of $500 billion. The actual committed equity, $52 billion. That is $19 billion from SoftBank, $19 billion from OpenAI, $7 billion from Oracle, and $7 billion from the Abu Dhabi fund MGX. The remaining $448 billion. It is supposed to come from debt financing that hasn't been secured yet. SoftBank's own CFO admitted the project was taking longer than anticipated. Sam Altman himself in August 2025 said the quiet part out loud at a press dinner. Are we in a phase where investors as a whole are overexcited about AI? Yes, Sam, yes, they are. And you are the one cashing their checks. But even the checks might not save OpenAI from its biggest problem. Competition. ChatGPT's web traffic share fell from 86.7% in January 2025 to 64.5% in January 2026. In 12 months, OpenAI lost over 22 percentage points of market share. Google's Gemini grew from 5.7 to 21.5%. Anthropic's revenue grew from $1 billion to over $5 billion in 8 months. Apple signed a deal to integrate Gemini into Apple Intelligence, cutting OpenAI out of one of the biggest distribution channels on the planet. And in December 2025, Sam Altman declared a code red internally, delaying advertising, shopping agents, and other revenue features to redirect resources toward improving ChatGPT after Google's Gemini surpassed it on key benchmarks. The most valuable startup in the world declared a code red. Let that sink in. But even if OpenAI somehow figures out how to stop hemorrhaging money, there is a problem that no amount of venture capital can solve. This is nail number 6, the infrastructure overbuild. The most expensive construction project in the history of civilization is being built on a bet that demand will materialize. And the numbers are staggering. Morgan Stanley estimates that big tech will spend $3 trillion on AI infrastructure through 2028. Their own cash flows cover only half of that. The rest comes from debt. McKinsey projects that total AI investment could reach $7 trillion by 2030. For comparison, the entire Manhattan Project cost $30 billion adjusted for inflation. The Apollo program cost $288 billion. We are talking about spending orders of magnitude more than the programs that built nuclear weapons and put humans on the moon. And we're doing it to build chatbots that sometimes get the answer right. Here's the capacity math that should terrify you. In 2026, global AI infrastructure investment is approaching $400 billion annually. But enterprise AI revenue remains capped at approximately $100 billion. That is a 4-to-1 ratio of spending to revenue. You are building $4 of factory for every $1 of product you can sell. That is not an investment. That is a fever dream with a spreadsheet. Sound familiar? It should. In the late 1990s, telecom companies spent hundreds of billions of dollars laying fiber optic cable across the ocean floor and under city streets. They were building for an internet future that they believed would require infinite bandwidth when the dot-com bubble burst. Over 90% of that fiber went dark, unused. The physical cables were fine. The engineering was brilliant, but the demand wasn't there. Analysts at D. Davidson drew the exact parallel. 25 years ago, the original dot-com bubble burst after debt financing, built out fiber optic cables for a future that had not yet arrived. If we get to the point after spending hundreds of billions of dollars on data centers that we don't need a few years from now, then we're talking about another financial crisis. That is not a blogger saying that. That is a Wall Street analyst, and the physical constraints are hitting. A single AI query can consume up to 1,000 times more electricity than a traditional web search. AI data centers are projected to consume 6% of total U.S. electricity by 2026. PJM Interconnection, the largest U.S. grid operator serving 65 million people across 13 states, projects it will be 6 gigawatts short of its reliability requirements by 2027. In central Ohio, one couple's electricity bill jumped 60%. Their neighborhood has 130 data centers. A Carnegie Mellon study estimates data centers could raise the average U.S. electricity bill by 8% by 2030, and over 25% in high-demand areas like Northern Virginia. You are paying for AI with your electric bill, whether you use it or not. This brings us to nail number 7, the concentration trap. If you have a retirement account, a 401k, or an index fund, you need to hear this, because you are more exposed to the AI bet than you think, and you probably didn't choose to be. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, now represent 34.3% of the entire S&P 500. One-third of the benchmark that nearly every retirement fund in America tracks. That is the greatest concentration in half a century. In 2016, these same companies were 12.5%. They have nearly tripled their share of the market in a decade. And here is the number that should scare every financial advisor in the country. In 2025, roughly 42% of the S&P 500's total return came from the Magnificent Seven alone. That means the other 493 companies in the index contributed less than 60% of the gains, and only 2 of the 7, Alphabet and Nvidia, actually outperformed the broader market. The other 5 underperformed the S&P 500 or barely matched it. The concentration isn't just a risk. It is already showing cracks. In January 2026, the S&P 500 gained 1.9%. The Magnificent Seven gained only 0.8%. Microsoft fell 12.5%. The rotation has already started. A Bank of America poll in December 2025 found that investors see an AI bubble as the biggest tail risk event in the market. More than half of respondents said the Magnificent Seven is Wall Street's most crowded trade. 54% of global fund managers view AI stocks as being in bubble territory. And yet the money keeps flowing in because the index forces it to. If you own an S&P 500 index fund, you are automatically putting a third of your money into 7 companies whose valuations are predicated on AI transforming the global economy. You didn't make that bet. The index structure made it for you. If AI stocks correct by even 30%, which is modest by bubble standards, Goldman Sachs estimates the market could lose $30 to $40 trillion in value. That is not a correction. That is an extinction event for retirement portfolios. And unlike the dot-com crash, which was concentrated among tech speculators, this one would hit everyone with a 401k. Nail number 8.com D70VU. And if you think you've heard this story before, you have. In the late 1990s, the internet was going to change everything. And it did. Eventually, but first it destroyed $5 trillion in market value. The Nasdaq peaked at 5,048 in March 2000. It fell 78% to 1,114 by October 2002. It took 15 years to recover. 15 years. An entire generation of investors waiting to get back to even. And the parallels to today are not subtle. They're screaming. The Case-Shiller price-to-earnings ratio for the U.S. market has exceeded 40 for the first time since the dot-com crash. The S&P 500 is trading at 23 times forward earnings. AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending. Venture capital funding for AI startups surged to 58% of global VC allocations in early 2025. There are 498 AI unicorns, companies valued at $1 billion or more. Over 1,300 AI startups have valuations above $100 million. But here is the difference the bulls keep citing. This time they say, the companies are profitable, Nvidia makes money, Google makes money, Meta makes money. And that is true. The Magnificent Seven have aggregate profit margins of 28%, nearly double the rest of the S&P 500. But here is the counter-argument. In the dot-com era, Cisco Systems was also wildly profitable. It was the most valuable company in the world in 2000. It traded at over 200 times earnings. Its stock crashed 80% and still hasn't recovered to its 2000 peak. 26 years later, being profitable doesn't make you immune to a bubble. It just means you have further to fall. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, said in early 2025 that current AI investment levels are very similar to the dot-com bubble. Jamie Dimon, CEO of JP Morgan, warned that an AI-driven stock crash could wipe out massive amounts of invested money. He acknowledged AI would pay off eventually, just like cars in total paid off, and TVs in total paid off, but most people involved in them didn't do well. Think about that last part. Most people involved in them didn't do well. Cars transformed the world, but 90% of early car companies went bankrupt. The technology won, the investors lost. Television revolutionized media, but the companies that overinvested in early television infrastructure went under. The technology survived. The financial bets didn't. This is the pattern every single time. And here is a statistic that might keep you up tonight. According to Deutsche Bank research, if you remove the big tech companies from the equation, the U.S. economy would almost certainly be in a recession right now. The entire economy is being propped up by AI spending. JP Morgan's Michael Sembalist calculated that AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending. That is not an economy. That is a dependency. And dependencies have a way of turning into addictions. And addictions have a way of ending badly. This is nail number 9, the power crisis. The invisible ceiling. Every bubble has a physical limit. For the dot-com era, it was the overbuilt fiber optic cables. For housing, it was the finite number of subprime borrowers. For AI, it is electricity. And we are hitting that ceiling right now. The U.S. power grid was mostly built between the 1950s and 1970s. Approximately 70% of it is approaching end of life. And now we're asking it to power the most energy-intensive technology revolution in human history. 2 planned data centers in Wisconsin alone will require 3.9 gigawatts. That is equivalent to the electricity consumption of 4.3 million homes. A single state, 2 buildings, enough power for millions of households. And there is a 7-year wait for some new facilities to connect to the grid. 7 years in an industry where companies are promising to have their infrastructure running by 2027 or 2028. The grid can't keep up, the utilities are overwhelmed, and the bill is being passed to ordinary Americans through higher electricity rates. In the PJM electricity market stretching from Illinois to North Carolina, data centers accounted for a $9.3 billion price increase in capacity costs. The average residential bill is expected to rise by $18 a month in Western Maryland and $16 a month in Ohio. This is the hidden tax of the AI bubble. You don't own Nvidia stock, you've never used ChatGPT, and yet your electricity bill just went up because a tech company built a warehouse full of computers next to your town. That is not an externality, that is an extraction, and the political blowback is already starting. CNBC reported that data center projects have become lightning rods across the political spectrum. Senator Bernie Sanders on the left and Governor Ron DeSantis on the right have both raised alarms. Ordinary citizens are organizing against data center expansions in their communities. In Austin, Texas, a city analysis found that proposed data centers are seeking more than 5 gigawatts of power, more than the peak load for the entire city. One industry, One city, more power than every home, hospital, school, and business combined. Here is the analogy that makes this concrete. Imagine your neighborhood has a shared well. It has worked fine for decades. Then someone builds a car wash next door that uses more water than the entire neighborhood. Your water pressure drops. Your bill goes up. When you complain, you are told the car wash is the future of transportation hygiene. That is the AI data center economy. Except it is not water, it is electricity, and it is not a car wash. It is a $500 billion bet on whether chatbots will eventually be worth the brownouts. And that brings us to the final question, the one that nobody in Silicon Valley wants to answer. Nail number 10, the exit question. What happens when the music stops? Let me be clear about something. AI is real technology. It can do real things. Generative AI writes code. It summarizes documents. It translates languages. It assists with medical research. The technology itself is not a fraud, but the financial infrastructure built around it. That is where the audit gets uncomfortable. The core problem is the gap between what AI can do and what Wall Street needs AI to do. For AI to justify current valuations, it doesn't just need to be useful. It needs to generate trillions of dollars in new economic value. Not eventually soon. Because the companies spending hundreds of billions right now are financing that spending with debt, with stock dilution, and with the assumption that revenues will catch up to costs within a few years. If they don't, the math breaks. Think about it like building a highway. If you build a 10-lane highway to a town of 1,000 people, the highway works. Cars can drive on it. The engineering is sound, but it is a catastrophic investment because the demand doesn't match the supply. That is the AI infrastructure question. The technology works. But are there enough paying customers to fill all those data centers? And the answer, according to the MIT study, according to the revenue gaps, according to the enterprise adoption data, is not yet. Maybe not for years. And there are cracks forming. ChatGPT's web traffic share fell from 86.7% in January 2025 to 64.5% in January 2026. A 22 percentage point drop in 12 months. Google's Gemini grew from 5.7% to 21.5%. Apple just signed a deal to integrate Gemini into Apple Intelligence and future Siri upgrades, estimated at $5 billion. Competition isn't coming, it is here, and when everyone has the same technology, margins collapse. This is what happened to PCs, to smartphones. To cloud computing, the first movers charge a premium. Then the competition arrives. Then the premium disappears. Then the valuations built on that premium look ridiculous in hindsight. Even the insiders are nervous. The CEO of Google DeepMind, Demis Hassabis, said in November 2025, "It feels like there is obviously a bubble in the private market. You look at seed rounds with just nothing being tens of billions of dollars. That seems a little unsustainable." Anthropic CEO Dario Amodei said he worries about how others are behaving on the business side. The former CEO of Intel said the bubble has plenty of time before it pops. Sam Altman himself said investors are overexcited, when the people building the technology are warning you that the money around it is irrational. What more evidence do you need? The Bank of England issued a formal warning about the growing risks of a global market correction due to overvaluation of AI firms. They specifically cited OpenAI, which tripled its valuation from $157 billion to $500 billion in a single year. They warned that investors were not properly cautioned about the risks of a crash. If AI falls short of expectations, here is the scenario that keeps fund managers awake at night. Some quarter in 2026 or 2027, one of the big hyperscalers, maybe Microsoft, maybe Meta, maybe Amazon, reports earnings. Revenue from AI products didn't grow as fast as projected. The CFO says they're extending the timeline for returns on their data center investments. The stock drops 10%. That triggers a reassessment of every AI valuation in the market. NVIDIA's customers start canceling chip orders because they've already overbuilt. CoreWeave's debt becomes unpayable. Oracle's bonds crater. The circular financing machine that has been spinning money between 5 companies suddenly stops. And because these companies make up a third of the S&P 500, the whole market drops. Now here's what makes this different from the dot-com crash. In 2000, tech was maybe 15% of the S&P 500. Today, tech plus AI-related stocks account for roughly 45%. A 30% correction in those stocks wouldn't be a tech sector problem. It would be an everything problem: your pension fund, your index fund, your 401k, the endowments that fund universities, the sovereign wealth funds that fund entire countries. Everyone is in this trade, and most of them don't even know it. It is not a prediction, it is a diagram of a machine that requires perfect execution in every gear, every quarter for the next 4 years. One slip, one missed earnings call, one DeepSeek-style disruption, and the chain breaks. Morgan Stanley estimated that big tech's own cash flows cover only half of the $3 trillion they've committed. If revenue disappoints and the debt markets tighten, there is no backup plan. There is only a very large pile of servers in a very expensive building with a very high electric bill, and no one left to pay for it. So here we are. The verdict: the AI bubble is not about whether artificial intelligence works. It does. The bubble is about the gap between what the technology delivers and what the market has priced in. It is about $3 trillion in debt financing for infrastructure that may not be needed at this scale. It is about circular financing that makes revenue look bigger than it is. It is about 95% of companies getting zero return on billions of dollars in investment. It is about a power grid that can't keep up. And it is about a market so concentrated in 7 companies that a correction in AI would crater the retirement savings of every ordinary American. Here is the final bill of the AI gold rush so far. 1. Market concentration: 7 companies hold 34% of the S&P 500, the highest concentration in 50 years. 2. Infrastructure spending: over $3 trillion committed through 2028, with cash flows covering only half. 3. Returns: 95% of enterprises report zero measurable return on AI investment. 4. Losses: OpenAI alone projects $115 billion in cumulative losses through 2029. 5. Energy: AI data centers on track to consume 6% of U.S. electricity, raising bills for millions of households. The technology will survive. It always does. The internet survived the dot-com crash. Railroads survived the railway bubble. Radio survived the radio bubble of the 1920s. The telephone survived its speculative period. Every transformative technology in history followed the same arc: hype over investment, crash, and then from the wreckage, the real economy emerges. The companies that actually solve problems survive. The ones that were just burning cash hoping the future would arrive faster than the bankruptcy papers. They don't. When the dot-com bubble burst, over half of all public internet companies went bankrupt by 2004. Venture funding collapsed 95% from its 2000 peak. The Nasdaq fell 78%. 2.5 million people in the tech and telecom sectors lost their jobs. But out of that wreckage came Google, came Amazon, came the actual internet economy that we rely on today. The technology was real, the valuations were not. And that brings us to the human cost that no earnings call will ever mention. The retirement accounts that are 34% exposed to 7 companies. The electricity bills going up in Ohio, Maryland, Virginia, and Texas because a tech company needed a warehouse bigger than your town. The 2.5 million jobs that S&P Global estimates could be lost if the bubble bursts fully. The small businesses that spent their limited budgets on AI tools that the MIT study says delivered nothing. The young engineers who took stock options instead of salary at AI startups that may never go public. This is the part of the audit that doesn't fit on a balance sheet. The Guardian warned in early 2026 that if AI stocks collapse, it does not stop there with the sell-off. All other boats will start to sink as well. Because when a third of the S&P 500 is built on one narrative, a correction in that narrative is not a sector rotation. It is a systemic event. And that is the lesson that $5 trillion in AI valuations is about to teach us again. The technology is real. The bill is real. But the fantasy that every company spending money on AI will get a return, that the current prices reflect the current reality, that the shovels can keep selling at these prices forever. That is the bubble, and bubbles, by definition, are not visible from the inside. They only become obvious when they pop. Speaking of things worth paying attention to, if this forensic audit helped you see the numbers behind the narrative, hit that subscribe button. It costs nothing, which is more than most AI investments can say right now, and it tells the algorithm that breaking down trillion-dollar bets is worth your time. The AI revolution is real. What comes next? The correction, the consolidation, the moment the market separates the companies that actually make money from the ones that just spend it. That is going to be the story of 2026 and 2027, and I'll be here to audit every dollar of it. There will be winners. There always are. Nvidia may be one of them. Google probably will be. The companies that build real products that solve real problems for real customers at real prices will survive, and they'll be worth owning. But the 498 unicorns, the circular financing structures, the startups with 3 people and a $40 billion valuation, the infrastructure built for demand that hasn't materialized, those are the dot-com pets dot-coms of our generation. And their clock is ticking. Because remember, the biggest financial disasters in history were never caused by bad technology. They were caused by good technology that people priced as if it were magic. AI is not magic, it is math. And right now, the math says the bill is coming due. Economics isn't just about money, it is about reality always collects.